high noon. At least you're on the East Coast. So welcome, everyone. Thank you so much for joining today's live webinar, Beyond Stocks and Bonds, Growing Your Wealth and Alternative Assets. I'm Amelia Bourdeau. I'm a managing director at Diamond Standard, and we have three amazing guests today, and I know you're going to learn a lot from them. Cormac Kenny, he's the founder and CEO of Diamond Standard. Anthony Jang, he's the co-founder and CEO of Vinovest. And Alan Sokolitsky, he's the chief investment officer at Masterworks. So thank you for being here, everyone.
Thank you for having us, Amelia.
I wanted to kick it off because we may have some listeners who aren't familiar with all of the companies. So at first, I just want to ask you, could you introduce your company and actually describe the asset that the clients invest in? And the reason why I'm asking that is because each of you in your companies seem to have solved for making a less accessible asset more accessible. And I would think that there would be a lot of maybe proprietary technology and possibly patents around that asset in that process. So if you'd like to start, Cormac.
Thank you, Amelia. So we're obviously interested in diamonds. The company's Diamond Standard, and diamonds are extremely interesting because it's a $1.2 trillion natural resource that has never been financialized. You know, you can't trade diamonds on any spot markets. There's no futures. There's no options. And unlike gold or silver, it's because every diamond is a little bit different. And so you would never have a way to mark to market or have price discovery or transparency. So our solution is a technical solution, and it allowed us to create these commodities. These are Diamond Standard bars, and we also have Diamond Standard coins. And as you can see, the diamonds are inside, and the breakthrough is that these two bars are equivalent. They've been deemed good for delivery to settle, for example, futures and options, which are CFTC regulated and are currently in development to list on the MIAX and the MJEX exchanges here in the United States. But primarily, these are acquired by investors directly. They hold the spot commodity. And because these are all the same, you can trade them. And that's what Diamond Standard is doing now, is promoting this commodity and educating consumers of its availability.
Thanks, Anthony.
Hey, everybody. I'm Anthony. I'm one of the co-founders and CEO of Vinovest, and we exist to help investors access wine and whiskey as asset classes. So similar to diamonds, right? It's very difficult to be able to accurately price, trade, store, and transact both barrels of whiskey as well as bottles of wine. So Vinovest helps investors build portfolios and acquire investment-grade bottles of wine, barrels of whiskey. We handle safe custody and storage, temperature, climate controlled, and then also have created a market for investors to be able to trade with each other. And also because investors also enjoy direct ownership, they can actually take delivery, consume, enjoy those assets at the end of the day as well if they so choose.
Thanks, Alan. Go ahead.
Great, thank you. Thanks everyone for joining. So I'm Alan Sokolitsky. I'm the CIO at Masterworks, and what we are doing is we're making the now probably nearly $2 trillion art market accessible to investors. So it's another one of those sort of accessibility themes that I feel like a few of us have already been hitting on. The way it is in the art market, you know, many paintings, if you have even some familiarity with the art market, you probably know that paintings can often and easily sell for many, many millions of dollars. So if that were the only way to access art, you can imagine that the vast majority of investors would probably have a hard time buying even just one painting, let alone building a diversified portfolio of a few paintings, if each one of them would cost millions of dollars by itself. So what Masterworks basically did, and we were started in 2017, is we found a way to fractionalize all of the paintings that we buy. I won't necessarily here go through the step-by-step process, but think of it in simple terms as you start out with a multi-million-dollar painting, but then you can buy shares in that painting. So no longer do you need to put up the multi-millions to buy the entire painting. You can buy a few shares of that painting, and then you'll own a piece of that painting, and you can ultimately enjoy the rewards that ownership will yield for you as an investor when we sell the painting at the back end. And in recent history, we're now managing $800 million. And like I said, it's probably close to $2 trillion asset class, which is, you know, and another one of those few asset classes out there that's so big, and yet only in recent history have investors really begun investing in it. And for the art market specifically, that's largely because of Masterworks.
Thank you. I spoke earlier this week to Bill Kelly, who is the CEO of Kaya, which is a certified alternative investment analyst association. And we spoke a little bit about, which is the theme, part of the theme here is democratizing alt investing. And that's not an easy thing to do, but you have managed to have a breakthrough, all three companies on that front, and make these assets accessible to individual investors in the alternative asset space. But we also talked a little bit about once the asset is accessible, it can be difficult for the individual investors to have kind of transparency or due diligence or pricing around the asset so they can track it, you know. So can we speak to that a little more? What tools or information do you give your investors in terms of, can they find pricing? Do they know where their wine bottle is, or their artwork, or their diamond commodity? Can they check on it? So could you speak to that? Maybe Cormac, would you like to go first?
Well, we're somewhat different from the others. We're very lucky in that we have a fungible commodity, and that's really the key for commodities is you have a fungible unit that you can trade. And because these bars are all the same, they all have the same value on any given day. And therefore, we've been able to get them listed on data services like Bloomberg and Refinitiv and S&P, where there's a daily market price. And that market price is daily because people trade this on a daily basis, and that instigates price discovery, and it also provides liquidity. So for us, that's a very key aspect of unlocking diamonds. But once you have that spot commodity, which is what this is, we're now looking forward to developing other products. In some ways, like Masterworks and Vinovest, we also create funds, because it turns out, for example, with an IRA, your retirement account, you very often cannot hold diamond bars or even your collection of Roman gold coins. You can't hold in an IRA, but you can hold in a fund. So we've launched a fund recently, which I know Masterworks, for example, is very good at. But we're also now looking at listed funds and listed products, as I mentioned, the futures and options, which are already in development, and doing that worldwide. So listed products for us is really how we provide that much broader access and liquidity.
I see. But they can also check, just because I'm from Diamond Standard, they can check their commodity if it's stored at Brinks, right?
Right. So the other unique aspect of Diamond Standard bars is that there's actually a wireless computer chip that's inside the bar, and that chip allows anyone in the world to remotely audit the individual bar, which is sitting at Brinks. As you mentioned, we actually built a custom vault with Brinks, so it has that wireless technology to audit. The other feature of that is you can also authenticate a bar. If someone hands you a bar, you can simply take out your phone. Your phone has NFC technology, and you can interact with the bar to authenticate it. So audit and authentication, and the last feature is there's actually a blockchain token associated with every chip. And that token is right now the world's only regulator-approved commodity token. And it's through that token that people trade our commodity while it's sitting at Brinks. You can't trade the token while the bar is in your sock drawer. But if it's at Brinks, you can trade it.
Thank you. As I've said, all of these founders, CEOs have made technological breakthroughs that I can see. So Alan, do you want to speak to any transparency, due diligence, pricing?
Sure.
Where is the artwork?
Yeah. So in terms of pricing or valuations for the paintings, they're done on a quarterly basis. All of our investors, they have accounts on our website, so you can ultimately go to the site, you can see the value of all the paintings that you hold. Art is one of those things that is mostly an illiquid asset class. So, to keep it simple, the best comparison I would make is think of it almost like your house. It's possible that you can get an updated valuation for your house on a daily basis if you really wanted to, but on a daily basis, it's hard to imagine what that updated number would really mean to you. Chances are the much more meaningful numbers would come, let's say, every quarter or at the end of a year. That's when you would really get a more meaningful idea about what's your house specifically worth. With other illiquid asset classes like private equity, they're also done on a quarterly basis. And so we've sort of taken the same approach that our valuations are done quarterly. Our investors receive statements and they can ultimately access the value of all of their paintings on their accounts online. The other piece, so you asked where is the art stored? I'm sure you're not too surprised to hear that no, it's not just sitting in my basement somewhere. We keep it in high-end art storage facilities, so they're state-of-the-art, secure locations, climate controlled, so on and so forth. These are basically the same facilities that very large collectors, let's say in the United States, if they're not holding their art in their house, they probably keep it at these facilities that we also hold our art. We do, however, we've got a gallery that we built next to our office because we know that art is one of those asset classes that you can actually engage with in some way, shape, or form. It's a little bit harder to do with stocks. I mean, it's not to say that you can't go visit the companies whose shares you own, but maybe it's not always the most exciting thing to do. Nevertheless, with art, we actually rotate all of the art that we own throughout our gallery. So we do have investors who come in to engage with the art that many of them have invested in. And then the last piece,
beautiful paintings.
Yes, I always say to be able to eat lunch and host a lunch and have millions of dollars of beautiful art on the wall around you is one of the definite larger perks of the job for sure. And then the last piece that I was going to mention was just that all of our paintings, every single one of our offerings, you can find full documentation about it on the Securities and Exchange Commission's website. The reason why we decided to use what I like to call old school securitization, meaning to register things with the Securities and Exchange Commission, is because we knew that investors would find the SEC's process to be, of course, reputable and trustworthy. So if you actually go to the SEC's website, one of the funniest things is you'll actually type in Masterworks. You will see all of the, I don't know, at this point, probably close to 200 some odd offerings we have. And if you ever want to become an expert on any particular painter or a particular painting, you can read through the 100 some odd page document that each one of our offerings has. So there's extensive documentation there for investors to go through as well before they invest.
Yeah, that's amazing. I think you refer to it your pricing mechanism, because I took kind of a look at it, and I think external people in the art world, they kind of look at it too, right? Is that correct?
Yeah. So there's internal pricing, there's external pricing. Of course, we're well aware that, in order to build trust with our investors, they of course will want to know that there are external parties valuing the art as well. That's sort of a no-brainer. So we do valuations internally. We also have external parties that value the pieces. And the appraisal process, honestly, I mentioned real estate before. In a lot of ways, it really is very similar to real estate. So, if you're thinking about buying a house, whatever, maybe it's 3 bedrooms, 2 bathrooms, whatever the case may be, you'll probably look at what did other houses in the same neighborhood recently sell for that also had 3 bedrooms and 2 bathrooms. Then you make proper adjustments. Maybe those houses were a little bigger, maybe they were a little smaller, whatever the case may be. But recent sales of similar assets give you an idea about the house you're thinking of buying. The process is actually extremely similar for art, where for whatever asset you're holding, you look for similar sales that have taken place. hopefully the painting was around the same size, hopefully by the same artist, hopefully painted at around the same time in that artist's career. So the only thing that really differs between real estate and art would be, with real estate, you're talking about houses. With art, you're talking about paintings. But other than that, the idea of valuing it based on similar sales that have taken place, that's basically the same in a nutshell.
Thank you. Anthony, I'd love to hear from you. I'm guessing not all the wine is stored behind you, but that is an awesome background that you have. So any transparency on pricing, or how do you move the wine? Where do you get the wine from when it's time to sell? How would that work? Who do you sell it to? And do you give any reports or have due diligence for your investors?
Happy to walk through that first on the pricing side, then we can move into custody, diligence, as well as research. So on the pricing side, wine is, I'd say in terms of tradability, somewhere in between what Cormac and Diamond Standard has created, as well as what Masterworks has created, in which there are wines that trade every day on the market, mostly for consumption and shipping all around the world. And other wines, maybe they're traded weekly or on a monthly basis. So what we do at Vinovest is we aggregate third-party pricing from marketplaces, from exchanges, from trade channels, and we're able to then clean that data and normalize it into a global order book and pricing engine that we then show to our investors, which is updated on a daily basis. So these are based on real trade points, real offers and bids that come out into the market externally that help inform our Vinovest pricing. When we acquire a bottle of wine or a case of whiskey, we do it usually directly from the source. So from the winery or the exclusive distributor for the winery or distillery. And when it comes to storage, we want to store it as close to the source as possible. So wine that we're purchasing from France or Italy, it's going to be in Europe. Wine that we're purchasing in California, we have a California storage location. Whiskey, whether it be Scotch, is in Scotland, and American whiskey is in the United States. And each investor is going to be able to receive an ownership certificate for their asset, whether it be a bottle of wine or a case of whiskey, a barrel of whiskey, and be able to know the exact storage location, contact info. And for certain clients, we also offer the ability for them to be able to tour our facilities and be able to actually see their collection in person, which I think is important. Not as fancy as an art gallery, but we have highly regulated and highly secure storage facilities all around the world that are humidity, temperature controlled, and are able to provide that safety of storage, because that's a big risk if a individual investor or private investor is looking to do this on their own. Wine can spoil. That's a very large risk for the safety of the asset class, and we take that safety very, very seriously. Finally, on to information. We provide research, detailed analysis on why each wine is investable, down to not just the region, the producer or the winery, and then even the exact vintage year. So we provide detailed analysis on every single wine to help educate our clients on why we think this is an attractive buy, when we think the exit window would be, and when that exit window comes, right? Every wine has a maturity window, a maturity period. We assist our investors in looking for an exit. And the person on the other side could be another collector, another investor, could be a retailer, high-end restaurant. A lot of the liquidity in our market, thankfully, is already built in because people drink wine on a daily basis. So we have that sort of natural liquidity engine. And at the end of the day, every single bottle of wine that is consumed makes the asset more scarce, makes the other remaining bottles of wine a little bit more valuable as well.
That's so interesting. Thank you. So I wanted to ask you, as an aside, I don't know if you're going to answer this question. It's a little personal. What is the most expensive bottle of wine that you have ever drank?
Ooh, so this is a fun story, actually. At the end of last year, we hosted our first in-person team retreat. So after about 2.5 years of COVID pandemic and Zoom phones, I thought it was definitely fitting for our team to be able to come meet in person and blow off a little bit of steam. And something that our team did was a blind tasting. So each one of our 20-odd team members brought a bottle. They got to share it and put their best guess on what it was. And I brought a bottle of 1992 Domaine de la Romanée Conti. which is a about $30,000 bottle of wine. And I poured it. Everyone was making their guesses. People were guessing Bordeaux. People were guessing Italy. Maybe some got Burgundy, but nobody knew that I was going to be bringing this. And the expression on everyone's faces when I revealed the blind off the bottle was certainly worth $30,000. And that remains probably the most expensive wine that I've consumed, and probably our whole team has consumed together. But for me, right, at the end of the day, someone's got to enjoy it. Someone's got to consume it. And great wine is meant to be shared with great people, and it was a fitting occasion.
Wow, that's a great story. I'm glad you shared it, and that is such a true statement. Great wine is meant to be shared with great people. Moving on, all three of your companies, all three of your founders have disrupted these kind of long-standing industries, right? Diamonds, the art industry, the wine industry, and how do more traditional players in these industries view your company, and do you interact with them, and how do you interact with them? So I know kind of at Diamond Standard, Cormac, you built an exchange, your own loose diamond exchange, but I don't know if you want to speak to that or something else, but go ahead.
So the diamond industry is really huge globally, and it's really a giant triangle. And at the very top, you have the mines. And we actually don't interact directly with the mines. We buy there's about 300 companies in the world that actually buy all the rough diamonds. That's it. There's only about 300. And most of them actually cut the diamonds. And so we interact with all of them. We have about over 200 or so of these site holders, they're called. And they're the ones that are members of our exchange and offer us diamonds. So with them, they were very incredulous at first. And I hear it now from investors all the time. So many people tried to solve this challenge and create a investable diamond product. There's been a lot of failures. And so the industry and the investors were conditioned to be incredulous. And that made it very, very challenging to get their attention. And in the digital world, there's all kinds of people that are tokenizing diamonds and trying to make them something that you can trade, but they're really just ways to sell diamonds at a markup. And so we had to really do a lot of education. And what we found most helpful is that the very first step we took was to get regulatory approval and oversight. And we achieved that in Bermuda. We couldn't go to the CFTC because they can't regulate spot commodities. They can only regulate derivatives. So we were very fortunate that Bermuda was willing to give us a chance. And it actually took us 2 years to convince them that our process was fair and transparent and solved issues like money laundering and terror financing, and created that transparency and reliability. And we also managed to get Deloitte as an auditor. They internally audit our process. Once we had that regulatory approval and we had an auditor, then that really allowed us to interact with institutional investors like BlackRock, for example, and exchanges like MIAX and the CME and MGEX and others, the TSX, for example, and get them to realize that we have actually solved this. In the rest of the diamond market, it's a little different, because basically now that we've built an exchange, we're disintermediating a lot of the brokers and traders and dealers historically that moved diamonds throughout the supply chain between countries and sorted them into different sizes and categories. We're basically buying diamonds from the source and sealing them at wholesale, basically. That's why when you sell this commodity, you can basically sell it at the market price because you don't have to give back all the markups. That makes a lot of enemies. Everyone who historically marked up diamonds, they're not so thrilled with what Diamond Standard does. But interestingly, once you get down to the jewelry manufacturers, like the Tiffany's of the world, their first question is, can we buy diamonds next to you? Can we use your exchange? Can we cut out the middlemen the same way you do and take advantage of what we have global settlement. We have 8 offices around the world where we buy diamonds and we pay COD and we move them wherever we need them. So the bottom of the supply chain, they're very interested in what we're doing. The middle, not so much. But that's technology in a nutshell, making things more efficient. And that's a big part of what Diamond Standard does.
Yes, and we're not together to but I believe we're going over the Diamond District now as you speak, and that is something interesting about Diamond Standard, that you interact with the more traditional diamond market, but also traditional finance market, as well as you mentioned with the institutional investors anyway. But Alan, how about you? How does Masterworks interact with the more traditional players in the art market?
Yeah, so it's interesting because once you have I guess a thorough understanding of what our business does, it's easy to look at that and think, well, that's doing something with art that's really never been done before, so it must be totally foreign in terms of how other traditional art market players view you and interact with you. But then if you actually think about it a little more, you realize what goes on after we buy the art is actually entirely separate, distinct, and in a lot of ways sort of irrelevant to whoever is selling us the art. And then on the back end, when we are selling a piece to a collector, an intermediary, whatever the case may be, it's sort of irrelevant to them what happened to that art for the last 1, 2, 3, 4, 5, whatever the case may be. For them, it's just a matter of, okay, I'm getting to buy this beautiful multi-million-dollar work of art that's an institution called Masterworks that's selling it to me. So in a lot of ways, the way that we interact with the traditional players in the art market is not necessarily that different from how they normally interact with each other, right? They are buying and selling art from each other. We are buying and selling art with them as well. The only thing that's truly unique and different is what is happening sort of in that middle ground between when we buy the art and when we finally sell it, because that's when we ultimately fractionalize it and make it available to investors. But what other art market participants see is just another institution that's buying and selling art in the art market. So in that sense, we're interacting with traditional art market players mostly along the lines of the ways they've been used to. Another piece that's interesting is over time, I think art market participants have grown significantly more favorable about what we're doing, because what they've realized is our existence in terms of democratizing the art market is bringing an entirely new source of capital into the art market that had previously never existed before, right? You can do the math in your head to figure out how many individuals or families are there in the world that can regularly buy, 10, 20, 50, $100 million works of art. There are probably not too many of them. But when you create a business that allows for investing in the art market, and all of a sudden those price points for people to get in are so much lower, that's a whole new source of capital coming into the art market. So that's a big plus. The other one is honestly from an educational perspective. The funny thing is, art has always been one of those topics where unless you are talking to a real true art expert, if you ask someone, how much or what do you know about art, there's often that joking comment about, oh, I have absolutely no idea about art. I don't know the difference between this painting, that painting. And I think at least on the margin, we are doing a lot to bring education on the art market for the broader investor community, because ultimately, when you're investing in a painting, you're having a full understanding of what particular type of art that is, who is the artist that painted it, what were the themes that particular artist was trying to exhibit in their work? How is this work different from maybe another work that the artist painted either 10 years later or 10 years before? Was it a different point in their life where something was going on that they were trying to sort of express their emotions about that in this work versus another? There's a lot of education that our investors are actually getting on art. So I think, in total, we're interacting with traditional art market participants not that differently from how they've been used to interacting with others before. We're bringing new capital into the art market, and we're educating a pretty big segment of the population on this thing called art that, previously their answer would have been, oh, I don't know anything about that. Now they're actually getting quite educated on a lot of different pieces.
That's great. Education for the individual investor in the alt space.
It's huge.
A huge issue. Yep. As I mentioned earlier this week, I did speak with about that topic exactly with Bill Kelly, who's head
Yep.
of Kaya. So
Yep.
interesting. So now here comes like your more kind of personal question. Is there an artwork that's just your favorite, whether Masterworks owns it or not, or it's in your gallery? And I'll go first. Mine is a painting by Jules Bastien Lepage at the Met, Joan of Arc. So do you have one?
So I've grown more favorable on Jean-Michel Basquiat over time. He is an artist that we do own several of his paintings. In fact, probably more than several. We have had his art in our gallery. I think previously, maybe I wasn't so favorable only because I guess I didn't fully appreciate his own background and history and how much it fed into the art that he was producing. In fact, there was an art show in New York City. I think it was probably about a year ago. I don't know if it's still going on, but it was basically an entire gallery dedicated to his works as well as his life. I mean, there was actually a lot of history that you learned about him. I took my family there. I was doing some explaining. The museum itself was doing some explaining. So it's one of those things where, the more you learn about something, you can actually become more and more interested in it. And previously, you might have had some not the most accurate conceptions about something, then you get corrected and you realize, maybe there is really a lot more to this art than you previously thought. So I would put Jean-Michel Basquiat up there for sure.
Thank you for sharing that. I didn't forget about you, Anthony. So how does Vinovest interact with the more traditional wine market, and also whiskey? I don't think we answered the question yet. Why whiskey as opposed to tequila or something? How did you choose whiskey?
Yeah, well, tequila is coming soon, but with the
Wow.
whiskey market, it was truly driven by the demand for our clients. Um, Similar to the wine market, the aged whiskey market has been booming. Um, People pay a premium for an 18-year-old single malt Scotch versus a 12-year-old versus a 10-year-old, and a lot of that value comes within the maturation. While it's in the barrel, right? There's going to be something that nobody can speed up or slow down for demand, and that's just time, right? And 20 years ago, we did not anticipate how many more participants would demand this aged rare whiskey than we did today. And that's really what's driving the market, right? We buy barrels that are younger, we hold on to them until a certain bottling date, whether at 12, 15, 18 year, even into the 2 decade, 3 decade realm, where they're ultra rare. And that's really what drives the appreciation in whiskey, similar to how people prize aged wine. And there's just less of it around, and people appreciate the taste. And when it comes to what Vinovest interaction with the market is, I see a lot of similarities with the stories that Alan and Cormac have told, especially with these top distilleries and these top wineries, right? They have a product that is very, very finite in supply, and demand outstrips it. So they can really pick and choose who they want to work with. And in the beginning, we were definitely met with a lot of skepticism. People were like, hey, we haven't even heard of you. Why should we sell you some of our prized allocation when we can just sell to the same people we've been selling to for the past 2-3 decades, right? Who my mother and father were selling to, who my grandparents were selling to. The alcohol industry, especially on the luxury end, is very, very traditional and relationship driven. And I think the reason how we've been able to get such strong relationships in a relatively short amount of time is through access and education, and also a generational shift. Right now, most of the high-end luxury whiskey drinkers and wine drinkers are in that sort of baby boomer age, where in the next 10, 15, 20 years, they're going to be buying and consuming less, just purely due to age or due to health reasons, right? Maybe their doctor is going to tell them you can't drink alcohol anymore at all. So all of them are focusing on the next generation. And I'm sure we've seen reports on how people are drinking less wine, right? Especially on the luxury end. So a lot of these brands are looking to engage with the Gen X's, with the millennials as well, and being able to treat this as an investment, right? Not just a consumable, as something that is going to be doing well for you and for your future, and being part of that wealth building cycle in your portfolio. That's truly interesting to a lot of Gen Xers and millennials out there. And the wineries love that. They love that they can get their brand in front of this market that it's been really traditionally hard for them to be able to speak to and be able to then tell the story, right? And people, to Alan's point, right, once you're invested in something, you're just automatically going to be a little bit more interested in it, starting learning the nuances between why did we buy you the 2016 vintage versus the 2017 vintage of Lafite Rothschild, right? And what's the difference between Chateau Lafite and Chateau Mouton, right? And the history in it and what makes that specific brand special. That part is extremely attractive to our winery partners. And in addition to just allowing our investors to invest, we also host wine tastings, winery tour visits, and really be able to make the asset come to life. And that experiential component of Vinovest, I think, is also really important to becoming a good long-term partner as well.
Great, thank you. So my background is macro trading and sales and strategy. I sat on a trading desk for many years on Wall Street. So let's get down to the numbers and to portfolio allocation. So as we all know, over the past 2 to 3 years, the 60-40, the more traditional portfolio, has not performed well. And so that has led to more focus on alternative assets, to find alpha, to diversify portfolio to lower beta. So can you talk about your returns or the volatility or the average holding period of these assets? Because I should note that in traditional alternative investing, at least, these are longer term, typically, holdings that investors have. So Cormac, would you like to go first?
Sure. Yeah, so diamonds have, everyone's very familiar with diamonds, and they've never been accessible. And what we've noticed is that if you go back 20 years and look at gold and silver and platinum, there was in 2002, basically, there became all the ETFs that really made precious metals much more accessible. And they became much more financialized. And since then, precious metals have actually gone up between 5 and 6 times in price over the last 20 years. But during that time, diamonds stayed almost perfectly flat. And now they're, gold has outperformed diamonds by 6x in 20 years. But now what we've noticed is in the last 2.5 years, since we've first launched the diamond commodity, they've actually outperformed gold by about 20%. And in fact, diamonds outperformed the S&P 500 fairly significantly until recently. The S&P kind of recovered and diamonds have slid a bit. But we look at that kind of long-term potential, and we think that as diamonds become financialized, we look at that return of gold over that period, and we think is 3x, 4x, 5x possible? And in that context, it does seem like it is, and it does seem like it's already starting to begin. We have, a lot of institutional investors that have been beginning to build positions. And as a former quant myself, I ran quantitative trading for Paul Tudor Jones for many years, and then Millennium. And so my background is also financial markets. What I never noticed before, or never discovered, was an asset like diamonds, which have extremely low volatility. Diamonds have about a 3.5% volatility compared to gold, which is 7 or 8% volatility, and stocks obviously quite a bit more. So diamonds provide this stability of a low volatility asset. They have this upside potential as far as return. And most interestingly to a quant, they've exhibited nearly zero correlation. So if you're running a multi-billion-dollar portfolio, an asset that has positive return, low volatility, and no correlation improves what your Sharpe ratio is kind of a key metric that they look at. And so diamonds end up being accretive. They add value to any portfolio. But most importantly, we look at 2 key drivers of what's going to cause the price of diamonds to go up. People think, oh, it's because you guys are buying diamonds to put into these bars. That's part of it. But actually, there's a much more fundamental imbalance that's been growing in the market, which is that they haven't discovered any new diamond mines in over 20 years. The last mines were discovered in far northern Canada. The only new source has been some diamonds found on the bottom of the ocean. In fact, now there's 5 ships operated by De Beers off the coast of Botswana and South Africa, where they dig up diamonds off the bottom of the ocean. That's not very many, but the supply of diamonds is actually falling by about 3 to 5% per year. In fact, 2 of the major mines have closed in the last 3 years. They closed the last mine in all of Australia last year, which used to supply about 12% of diamonds. So the supply of diamonds is diminishing because of lack of discoveries. And at the same time, the demand for diamonds is increasing. A lot of people hear, oh, synthetic diamonds are growing. Synthetic diamonds trade for basically 5 to 10% of the value of natural diamonds. So natural diamonds have actually been growing in demand by about 5% per year. And that's being, in the United States, they're increasing, but really notably in China, there's a lot more demand for diamonds. So fundamentally, you have diminishing supply and increasing demand. And as a, student of economics, that's something you want to invest in. And it's part of this super cycle of commodities where it's already started 2 years ago. Commodities returned 40% last year. And we think, super cycles generally last 10 and even 20 years, where we're seeing it in battery metals and steel and everything else. We think commodities are a very good play. And in general, we think alternatives are a good play. And that's what the 3 of us are talking about as a category.
Thank you. You also, now it's time for your kind of more personal question. And I believe that you had an inspiration for your company, why you kind of got interested in diamonds in the first place. Can you talk just a little bit about that?
Well, yeah, I'm a computer scientist and a quant, so diamonds were never on my on my radar, to say the least. But it's because of my wife. She's a famous jewelry designer named Mimi So. She was the first U.S. brand to be part of Richemont, which owns Cartier and Van Cleef and Arpels, and she was the only American brand as part of Richemont. And for 20 years, she complained about diamonds. I joke that she talks in her sleep about diamonds. It's a little bit true. But because of that, I absorbed a lot of information about diamonds. And I wasn't so interested in I like they're beautiful, et cetera, and geologically interesting. But what I really was fascinated by was just how big the market is. It's, like I said, a $1.2 trillion natural resource. That's the above ground diamonds. That's more than all the silver, all the platinum, all the palladium, all the rhodium in the world combined. Diamonds are worth more than all of them, second only to gold. But as an investor at Tudor or at BlackRock or State Street or Fidelity or JP Morgan, they don't own one diamond. They all have gold. They all trade gold, but they could never touch diamonds. And so I had enough knowledge and I was inspired and came to believe that it was a computer science problem that could be solved using automated market making to discover the value and statistical sampling to create the unit, and then optimization to make sure that every unit is statistically equal. So it was a fun computer science problem, but it's all my wife's fault that I fell into the trap.
Well, I like that story. That's a great story. I should mention we're getting close to the time where we'll be taking questions. So if you have any, please pop them in to the Q&A section, and we will take them shortly. So Anthony, coming back to you, let's talk some numbers. Return, volatility, average holding time for wine. What is it?
Yeah, and I think first of all, Cormac, that makes so much sense from a fundamental economic level, and that's similarly what drew me to wine. We're no stranger to climate change. Many of the world's most famous and storied and historical wine regions have been producing less and less wine every year. Regions like Napa, Champagne, Bourdeau, have all had much more volatile weather, which has led to inconsistent but overall decreasing yields every year. So even if you wanted 10 million bottles from a famous Napa winery, they just have this patch of land and they're farming less and less of it. So you have that decreasing supply from the get-go. And then once that bottle is released, you have the consumption curve, right? Every single bottle after release, every single year after release, there's going to be less and less bottles of a particular wine, a particular vintage every single year. So unlike diamonds and unlike art, wine does have a maturity window, right? It's something that can't last forever and hundreds of years and thousands of years like diamonds and art can if stored properly. So our wine investment window is also tailored to the actual maturity window of the wine. So when we onboard a new investor, we also ask them what their preferred exit timeline is. And we usually maintain a minimum of a 5-year timeline for wine. For whiskey, it can be shorter, closer to 2 years, given the different nuances of the maturation process. But wine can be aged for 10, 15, even 20 years before it reaches its peak. So we have very, very long-term investors, patient investors in that time for a long buy and hold. And we can also ladder up our investors' portfolios similar to a bond ladder if they want to be able to say, hey, I'd like to hold this asset class for 10 years, but I'd like to see some exits at year 3, year 5, year 7, year 9. And that also helps our team be able to manage portfolio construction to create exit windows at those desired times for our investor. Speaking of returns, volatility, and correlation, wine as an asset class has been around a 10, 11% a year annualized return asset for the last 30 years. Whiskey has been a little bit higher, and especially in the last decade or so, driven in big part by bourbon and high-end scotch. So that's been closer to 12 to 15% for the past 15 years. And when we're looking at volatility, both of them exhibit about between a third to a fourth of the volatility of the S&P, which to Cormac's point leads to a very attractive Sharpe ratio, very attractive risk-adjusted return. And then perhaps most attractively in this environment is the lack of correlation. So last year, wine had a completely negative correlation to the S&P. Historically, it's exhibited only a 0.12 correlation rate. So it's something that can really be that strong hedge and diversifier in an investor's portfolio when they're looking at diversification options.
Yeah, I mean, I think that's important for all 3 of these companies and the assets. I mean, just kind of taking a markets perspective here, I have never really seen in my career such a divergence in market experts, in investment banking, in hedge funds, at government think tanks, disagree to the extent that they're disagreeing about how the U.S. economy at least will proceed forward, even in a shorter term, in the next 6 months. Certainly, so it seems like that means that there will be a lot of, in my opinion, uncertainty, and there'll be a lot of volatility. So it's interesting to have something that diversifies away from that, because we seemingly can't tell how the U.S. economy will evolve for the rest of the year. Not just me, also the Federal Reserve. So interesting. But Alan, would you like to answer these questions on return and holding periods and volatility?
Yeah. So post-warrant contemporary art, that's the segment of the art market that we invest in. That's the segment that's been appreciating for decades now. Let's call it mid-teens price appreciation, depending on what particular period you're looking at, 13, 14, 15% annualized over time. So that handily outperforms the S&P. And I could tell you that it would handily outperform international stocks, hedge funds. I could go all the way down the list, except that since the S&P has basically been the behemoth that seems to be beating everyone against all odds for a long time, I'll just leave it at post-warrant contemporary has seemed to handily outperform the S&P. So the performance there has been really well. For our platform in particular, we have sold, I'm going to break this into 2 categories. I'm going to tell you we sold 12 works under normal circumstances and 1 work under extremely unusual circumstances. The works that we sold under normal circumstances, those 12, we held them for about roughly 2 years, give or take. And the net returns that investors got were an average of 23%. In fact, by the way, all of that is on our website, so you could easily just go to the website and see it yourself. The highly unusual work that we sold, and I'm not going into detail on it, and I left it out, and you'll understand why in a second. That work we held for less than 2 months, and that generated a net IRR of 325%. So I put it in its own special category because it was a very unique circumstance. We don't want investors to expect that to happen with every work. It was very unusual, but that was the one-off. The expected time frame we tell investors to expect to hold is, let's call it 3 to 10 years. And all of that is driven by the data. I mean, earlier we didn't actually have a lot of time to go into, what drives your investment process. But one of the truly unique aspects of our business is that we take an extraordinarily quantitative and analytically driven approach to investing in art. When I tell people that, you won't be surprised to know that they usually look at me like I have 3 heads, because people don't usually think about art in the most quantitative manner. They think about, paintings and beautiful things to look at. What's quantitative about that? But we basically built what we think is probably the largest database of art market data in existence. That took a very long time to build initially, especially because the vast majority of the data was in paper format. It was not digitized already, and all we did was just grab it. We actually had to get it from paper into a computer. But so what we've done is we analyzed the data, and the 3 to 10 year expected hold is because what we found is, depending on the price point you get in, depending on the price you're able to sell, the sweet spot for where you can maximize returns for your investment is about 3 to 10 years. I always feel strange telling investors that, because like I said at the beginning, most of the investments that we sold them at around the 2-year mark. So what I guess I'm saying is, as an investment manager that has a fiduciary duty to their investors, if we can be opportunistic and realize a very attractive return for our investors in a shorter time frame than we initially thought, we will absolutely do that, just like any other fiduciary would do the same. But I never want to guide investors to expect 2 years. I say expect 3 to 10, but we can also be opportunistic, and we obviously have been before. So that's a bit about, the performance of the asset class in general. We've done quite well. And the correlation story, I mean, we don't need to beat to the same drum here, but it's basically the same idea. There's a presentation I give, and I have a slide that has this gigantic correlation matrix in it. Now, I've been in the industry long enough to know that if you want to make sure to put your audience to sleep, put a correlation matrix in the presentation. And I always followed that rule before I got involved with the art market. Now that I'm involved in the art market, and I realize that art has approximately 0 correlation to stocks, bonds, hedge funds, private equity, real estate, commodities. I could literally go down the whole list of asset classes. It's a consistent near 0 correlation across the board. So because of that, I use the slide now, and it doesn't usually put people to sleep now, but nevertheless, same story as what the others have talked about.
Well, interesting. The saying, picture's worth 1,000 words. So
Yeah.
I guess you have a great presentation with pictures of the artwork. You're going to do really, really well. Okay. So we're about to take questions, but I just wanted to ask each one of you, is there something that I didn't ask you that's important about the company that you just want to mention, because we haven't touched on it yet? Anybody have anything?
This is more for my own curiosity, but I'd be curious at looking at asset allocation, right? What do you typically tell your investors that they should or could allocate to your given asset class, especially given Amelia's earlier point that the 60-40 bond portfolio is essentially dead?
So for us, I had a background in asset allocation previously. That was one part of my role for many years when I was at Goldman. But it was interesting when we did this analysis for art, because I quickly realized, wait a minute, I'm working for a company that's making art an investable asset class. If I tell you that you should put X% of your portfolio in art, you're going to realize that, I'm a little bit incentivized to be telling you what that allocation should be, obviously. So what I did is I actually approached the asset allocation question in a little bit of a sort of indirect or backwards way. And the way that I did it is I started with a bunch of baseline portfolios that investors would never dispute. Those portfolios would be representative of a particular type of investor. So 60-40 portfolio obviously was one of them. Then I had a diversified portfolio, which was sort of a more advanced allocation. Then I had an endowment portfolio with healthy allocations to liquids. And what I did in this exercise was I basically said, if I start with those baselines, and out of those baselines, I make something as small as a 5% allocation to art, does that small 5% allocation to art frequently make the performance of the baseline portfolio do better? So in other words, I wasn't saying you're supposed to put 5% of your portfolio in art. What I am saying is, if you take your current baseline portfolio and you put 5% of it in art, and you find out that that 5% allocation allows your portfolio to improve its Sharpe ratio in 100% of the time, that starts to give you an idea about how much of an allocation you might or might not want to make in your portfolio to art. So it was sort of a frequency of improvement kind of argument with something as small as 5% that, you know, nobody's going to accuse me of trying to give them the hard sell on a 5% allocation.
Yeah, I think it's interesting. I think it's interesting too when we talk about the 60-40 portfolio that there's also the background issue, right? That the public market has gotten smaller, and the private markets have gotten larger. And so your companies also are kind of giving people access to private markets. The individual investors eventually, I believe, will have to allocate more to the private market space. Yeah. Anybody else have anything they wanted to mention? If not, we'll just ask a couple questions from the audience.
One other thing I was going to mention was just, I don't want to go too much into detail about how we actually securitize and fractionalize the paintings so that investors can buy shares. But one thing I wanted to mention that I think is important is the way that we do that process. The first step of that process is that we actually buy the paintings entirely with our balance sheet. So in other words, if you think about the risk that we are or are not taking relative to, let's say, other investment firms. I mean, I'll pick private equity here, especially because nobody's in private equity on this panel. The way it works with private equity is step one, you raise a whole lot of capital, right, from external parties, and then you go and deploy that capital in a way that you think will generate attractive returns. But from the get-go, in a lot of ways, the risk that's being taken is from the upfront capital being given in by the external parties. So what I'm saying about us that's very much in contrast to that business model is that we are actually taking all of the front. We are going out and buying those paintings with balance sheet capital first as a way to show that we have a lot of optimistic views on those particular paintings in terms of the performance that they can generate. And only after we buy the painting do we then fractionalize it and allow investors to come in. And I think that's a really important point to make because we're effectively taking all of the upfront risk, and it tells you there's a lot of conviction that we have in what we buy.
Thank you. There's just a couple questions from the audience. So this is kind of like this question about the larger markets, meaning not necessarily your company, but the art market or the wine market. Who are the largest consumers or investors in those spaces? So who uses the most diamonds or I guess buys the most wine globally? Like what region of the world?
I can kick this off from the consumption basis. So the United States is the largest consumption market for high-end wine as well as for whiskey, closely followed by China as a second. Though China is posed to overtake the United States, at least on the fine wine side, by 2026. So we see a large demand coming out of China. We've even seen that with the prices this year with China reopening after the COVID lockdown policies. So our market for consumption is closely correlated to new wealth. And there's a lot of new billionaires and millionaires being created in China and as well as in the Middle East.
Yeah, for diamonds, it's somewhat similar. It's United States or North America, I should say, is the largest market for diamonds, then Europe, but the one that's growing most quickly has been China and emerging economies, things that are becoming much more accessible for consumer products and luxury products. So we very much track the luxury product market to some extent. And that's the only use for diamonds. Our diamonds, for example, we have no industrial diamonds, and they're not especially valuable. But we're tracking that growth and demand.
In this interest of time, I'll say that the answer is pretty similar to what Cormac just said. So we can, some nuances are different, but in general, we're roughly the same idea.
Okay, well, great. That's all we have. Thank you everyone for joining. And I just wanted to mention, we should all think about like an event where we go to the gallery at Masterworks and we kind of have a showing of the,
And the wine tasting.
the wine, the Mimi So jewelry. I like this idea. So
Yeah. Vinovest will bring the $30,000 wine. I can already, this is going to be great. I'm pumped.
And maybe the tequila that was coming too. So
yes, absolutely. We can preview some of our new product in person.
I'm excited, and the diamond commodities sparkle so much. I love to look at them. All right, well, thank you everybody for your time today. I really appreciate it. And of course, for the wider general audience, you can find us all at our respective websites and learn more. Thank you for your time.
Thank you, Amelia. Thanks, Alan and Cormac.
Thank you.
Good.